The stock market has been on a roller coaster ride. How do you manage it? I'm Erik Brenner. We'll have some answers next on Your Wealth Health. Hello and welcome to another episode of Your Wealth Health. I'm Erik Brenner, President and founder of Hilltop Wealth Solutions, and glad you could join us here today. If you are watching us on Facebook, if you could hit that share and share this information with others that you may know will have some interest, as well as if you're watching us online at yourwealthhealth.com, thank you for that. Take a look at this. That's right. It's been a roller coaster ride. The markets have been up and down. You may feel sick at times. You may be wondering, should I have not been on this roller coaster? What should I do? Should I get off? Should I continue to ride the roller coaster? And so we're going to talk about that today. And with joining me today is Beth Foley, one of our wealth advisors based out of Royal Oak, Michigan, and she's coming from our office up in Royal Oak. Beth, thanks for joining me today.
It's a pleasure to be here, Erik. Thanks for having me.
Yeah. So, Beth, we certainly have seen the ups and downs in the market. We've seen a lot of action by the Fed and Congress and so forth. So what are some of your clients saying or asking as it relates to what's going on?
Well, it's certainly been a busy 4 months, that's for sure. Initially, as we came out of this or came into this, the questions that I was getting were some of the ones that we would consider to be obvious, such as, should I be here? Should I be getting out? What should I be doing? As the past couple of months have passed and we're settling into this volatility, I'm getting more of those longer term questions from clients. You know, things like, how is this impacting my retirement plans? Will I be able to retire? From one end of the population of my clients, and then from the other end it's what should I be doing? Should I be buying in? Should I be participating in this some way? And then the question has started to come up, when do we rebalance the portfolio to take advantage or to protect ourselves from all of this volatility?
So let's dig in a little bit. So certainly with where stocks are at, and we've had some volatility, but really I saw recently that the S&P 500 is up over 35% for the year from its lows. And the Fed has really done a lot. And they have publicly stated many times that they are going to continue to take actions to really help us through this global pandemic.
The Fed has taken a lot of action. They've been very decisive and they've been assertive in the steps they've taken. We've talked about this before on the show and on our bi-weekly updates of action was taken over a period of 3 or 4 weeks that would have taken months before to do. And as we're sitting here, you know, we had the initial CARES Act with about $3.1 trillion worth of Fed money coming into the system. We're looking for more action. We anticipate that there will be more, but there's nothing definitive yet as far as what that will be.
Yeah, so they talk about, they haven't used all their tools in the toolbox. And, really the financial crisis back in 08, 09, they learned a lot, didn't they?
They learned so much, and I think what comes to mind more than anything is when I apologize, forget the name of it now, but the country's largest money market account froze. It broke the buck, as they said. Money market accounts generally trade at $1 per share, and that money market account fell below $1 per share and ended up freezing that money market. And our clients' assets, investors all over the country had their what they consider to be their liquid money frozen to them. And I think some of the action that the Fed has done as far as buying up corporate debt, possibly moving toward buying up municipal bond debt, we've avoided that situation where we had money market accounts becoming illiquid, because that just generates more concern and more anxiety in the market if people can't get to their money when they need it. So some of that decisive action on the part of the Fed certainly stabilized bond markets, both long-term and short-term and money market accounts. So I think that was incredibly vital to helping us get through the initial anxiety and panic of the economy shutting down, the uncertainty of all of that over the past couple of months.
Yeah, and I think, Beth, along with those points is what I've shared with folks is that if they did not take the actions back in March, when really all this global pandemic really started to get some steam, and of course the markets dropped from the beginning of March to March 20th, I think was the low. If they didn't take action quickly, then it was a real liquidity issue. And liquidity simply means, as you stated, money markets frozen, not being able to go to the bank and get money out, not being able to sell an investment, potentially when you go in to sell an investment. And I think what we've perceived is they learned so much from 0809. The Fed has a lot of folks that are still within the Fed that were around in 0809, and they took that experience that they learned then and applied it and really saved the markets from even more of a downturn.
Well, I think perception is incredibly important here. You may not want to get any money out or redeem it. You may not need cash in hand, but knowing that you can do it if you need to certainly settles the nerves a little bit. As soon as somebody says that you can't have something, let's just point at toilet paper for a second. If somebody says you can't have something, the initial reaction is I need to protect what is mine and go and get it. So by knowing that there was liquidity in the system and that the Fed was taking action on that, probably prevented, whether it's an individual like you and me and our clients, or larger corporations or local governments from looking to get their money out and protect it, which calmed those fears quite a bit. So perception is not just that you absolutely can't do it, but perception that you may not be able to do something or get something certainly riles up the markets even more. And by the Fed taking such quick, decisive action, it tampered down those fears, I believe.
Yeah, that's actually that's a great point. I was at the store recently, and it's like the pasta, and there's certain areas that it's just the shelves are empty, and so you imagine relating that to money. And once if that came about and the word got out that there was an account frozen, you couldn't get money out, they would be lined up probably to get money out. So those actions certainly has helped us through up to this point, and they have said, hey, in the future, we're willing to do what it takes. And so I think we're not saying that that's going to solve everything, but and there's more volatility that we believe will come, but we do have those tools in the toolbox. So when we return to Your Wealth Health, what we're going to talk about is some strategies that you really need to think about as it relates to your own financial situation. We're going to talk about taxes and whether we think taxes are going to go up over time and how you may be able to utilize that to your benefit when you return. Welcome back to Your Wealth Health. I'm Erik Brenner. Thanks for joining me today. If you're watching us online at yourwealthhealth.com, thank you for that. If you're watching us on Facebook, you can hit that share button. We're going to share some valuable information that maybe some of your friends and family would be interested in. With me today is Beth Foley. She's beaming in from our office up in Michigan. And Beth, before the break, we were talking about the Fed, and we wanted to talk specifically about a couple tools that the Fed has that they may pull out of the toolbox.
Erik, the Federal Reserve has a great number of tools that they can use, and that should make us all feel pretty good about the steps that they can help to protect the economy a little bit in this. One of them they've clearly already deployed, which is buying bonds in the marketplace. So they're infusing cash and buying bonds in the marketplace, and they can continue to do that. They've already infused a great deal of money. Back in May, there was a $750 billion with the B purchase of corporate bonds. There's been discussion whether or not they will buy bond exchange traded funds. The Federal Reserve can also take action with interest rates. Interest rates have already lowered interest rates, and there's been discussion, could we go to zero interest rates? There's been discussion of the Federal Reserve pegging interest rates on medium-term bonds, and all of these things are meant to make it more attractive to spend money than to save money. So infuse the economy with money. And of course, one of the biggest things that they have control over of interest rates, the Federal Reserve met last week, and as I said earlier, one of my favorite phrases that came out of that is that Chairman Powell says that they're not even thinking about increasing interest rates. So it could be, like we saw back in 2009 and 2010, it could be a couple of years before we see the Federal Reserve increasing interest rates. And again, that is all meant to make it attractive to borrow money, to spend money, and that keeps the wheels of the economy moving.
So as we think about all this spending and the Fed and Congress stepping in, I know many people relate that to taxes. A couple weeks ago, we had on one of the leading experts in IRA and tax planning, and he said an important statement. It's not how much you make necessarily, it's how much you keep.
There's a lot of advisors that can make you money, but it's keeping it that counts. You could only spend what you keep after taxes.
So Beth, I think Ed Slott points out a very important topic. How important are tax strategies now?
Erik, tax strategies are important always because, as Ed said, it's not so much what you make, it's what you keep after you have to pay taxes. And frankly, as we were talking about all of these strategies that the Fed Reserve has taken to help keep the economy moving, that is all a bill to be paid later. We're going to have to make up for all of this action. And that, I believe, is going to come in the form of higher taxes. So tax strategies, as important as they always are, I think will become even more important because, frankly, I don't see how we're not going to have a future with higher taxes in it to help pay for all of this action that's taken place over the past 3 months.
Yeah, Beth, and I know we've got a graphic on actually the debt and what that now looks like, and to kind of put a justification, if you will, not that we need it, but a justification on potentially taxes going up in the future.
Yeah, that graph is pretty dramatic as we see that increase in the weight of debt as a percentage of GDP. As of the end of the second quarter, we're looking at about 190% of GDP is the weight of the U.S. debt. And what I find interesting is that spike, if you look at it, we're still kind of recovering from all of the debt that was taken on to help us recover from the Great Recession as well. So you can see that it's been kind of flat, growing a little bit, but now we've got this spike, which I think will continue to grow. So as a percentage of GDP, if you can imagine as an individual, if your personal debt were 190% of your annual income, you would be taking some pretty specific action to help relieve yourself of that debt load and the cost of debt on a regular monthly or annual basis. And I think that's why we're going to see action being taken in the future to help alleviate that debt that we're accumulating now.
Yeah, that's a great point. I mean, you think about that. So let's talk strategy. 401k, many 401ks now have the pre-tax option and the Roth option. The Roth IRA, if you're over 50 now, you can put $7,000 in there if you qualify within the income limits. We think looking at strategies like Roth IRAs and other strategies are even more important today because of what we're talking about, potential of taxes going up in the future.
That's right. First of all, being able to fully take advantage of your 401k plan with pre-tax contributions to help your current lower taxes. But if we think about in the future and where we think taxes are going to be and tax rates are going to be, if they're higher, we want to put ourselves in a position of having less taxable income. And that's what a Roth 401k or a Roth IRA can do for an investor. You're not getting that current tax break. If you make $1, you save $1. But you get the exemption in the future of you get to grow, and we're going to talk about time value of money, but as that asset grows over time, it's exempt from income taxes. So I think Roth IRAs and Roth 401ks, if they're available, are an incredibly useful tool in our toolbox. We've been talking about the Federal Reserve's toolbox, but this is one in our own personal toolbox that we can make use of.
Yeah, and we think about from a perspective of the tax brackets. So we've talked about this and showed graphics over many of our shows that we are in the lowest tax brackets historically, and they are wider than they were 10 years ago. And so I think the planning and how we're thinking about it now is if someone can shift more of their savings to something that will be tax-free, yes, they may be paying a little bit more tax today, but what's the trade-off there? So I think each of you need to consider, are you in the right mix? Let's take a look at time value of money, and then when we come back from the break, we'll talk about this more. But time value of money always surprises me. This graphic that we have shows someone starting at $250,000 at age 50. They're putting in $7,000 a year up until age 65, and we're assuming a 5% rate of return. And you can see that by the time someone gets to 65, you can see that they're already upwards of almost $700,000. And then by age 72, you can see just shy of $1 million. Now, if you would ask someone today, Beth, hey, you've got $250,000, you're putting $7,000 away. Do you think it'll be worth $1 million at age 72? I'm assuming most people would not assume that. But this is the time value of money we talk about.
This is the time value of money that we talk about, and it's about compounding of interest and dividends and growth over time as well. A 5% return doesn't seem like much. Well, maybe it seems a lot when, with the months that we've gone through, but just with the interest or dividends being reinvested and growing over time, if you can put it away and forget about it, the assets really can grow for you and work harder for you over time. And of course, the earlier you start, the better. And it's never too late to start saving. So making use of that Roth IRA, if you're over 50, the catch-up provisions, those sorts of things can really help to grow wealth over time.
Great. When we return on Your Wealth Health, we're going to talk about your risk, how you should think about your risk going forward and alignment with your financial goals, because you can see that just a simple 5% rate of return over time can mean a lot. Stay with us.
We, the people of the United States, in order to form a more perfect union, establish justice, ensure domestic tranquility, provide for the common defense, promote the general welfare, and secure the blessings of liberty to ourselves and our posterity.
We, the people, are all our heroes, and Perry Automotive knows that. Now until the end of the year, we're extending our local heroes discount to the people, because you are all heroes.
At River Valley Construction Group, we pride ourselves on being one of the top deck builders in all of Michiana. If you want to have a beautiful deck, whether it be wood or composite, contact River Valley Construction Group today. River Valley Construction Group, where we're building your dream deck in 2020.
Welcome back to Your Wealth Health. I'm Erik Brenner. Thanks for joining me today. And I have Beth Foley, who's coming in via Zoom from our office up in Michigan. And so we were briefly talking about volatility. And Beth, recently you shared this photo with the team. What is this photo all about, Beth?
Well, this photo was taken several years ago, and at the time it was all about getting a friend on a roller coaster who'd never been. But now I look at this picture, and I think it's a great example of what we're going through. And as we were talking about time value of money a moment ago, I look completely enthralled and love roller coasters. My friend Dave, not so much, but what we're looking at here is the roller coaster ride. Dave is a handful of years older than I am, and he was preparing for his retirement here. We can use that example, a little bit more caution, a little bit more uncertainty about what this roller coaster is doing for his future plans. Me, you know what? I got nothing but time in this picture. So the more ups and downs, the more opportunity is possible. So when I look at this picture in relation to our discussion today about roller coasters and the markets, that's what I see when I look at this picture today.
Yeah, so we hear a lot, from clients on, am I where I should be? Should I make any changes? And should I be timing the market or not? What do we say to some of those questions?
Well, I think, Erik, that what we say to those questions are what we've always said to our clients, which is know and understand what your risk tolerance is, know and understand what your time frame is that you have to work with. And if you understand that and your portfolio is allocated appropriately for those things, some of those questions go away, or at least the intensity of them. I truly feel that over the next few months, people should reevaluate their risk tolerance. It's one thing to look at a graph or take an evaluation questionnaire to say, this is what my risk tolerance is. And it's like, yeah, I can get these really high rates of return. That's what I want. I can tolerate the downside. No big deal. Maybe it becomes a big deal when you actually have to live through that downside of things. So I think going forward over the next few months, getting back to the basics, really thinking about how you responded to this volatility, how it made you feel, reevaluate timeframes, and is your portfolio appropriately allocated for those situations?
Yeah, and one of the things that we talk about a lot, I know, with clients, and we've talked about as a team is, making decisions based on emotion. Certainly this year, we reached that market low at March 20th, and then we're back and above, or where we started at, within a very short period of time. And if you made decisions back in that March timeframe, selling off, there's money that's lost that you'll never regain.
That is absolutely true, Erik. And what I've said to clients over the years, and I'm sure you have as well, is that deciding to sell is actually the easy decision to make. Deciding on when to get back in is the much harder decision to make. And that's where we're at now with some folks who did decide to step away and step out of the market. So strategies like dollar cost averaging, strategies like breaking up the investments over time, not quite as systematic, and knowing what your risk tolerance is and what is an appropriate investment model, and time frame for investments too. If you're investing for the long term, some of these little ups and downs as far as getting back in may not matter as much. We've looked at and shown graphs before about whether you miss the downside by a week or a month or two over the long term, you're never going to get it perfect. But if you get close to that downside and be in place for growth in the future.
Yeah, thanks, Beth. And one of the things we want to do here at Hilltop is we spend a lot of time on helping and educating folks, whether it's our clients or others that want to be more educated. It's not about picking the best stock or the best return. And so we have launched a brand new website that Beth and I just want to take you on a quick tour of at hilltopwealthsolutions.com. You know, this site, we spent a lot of time, effort, and energy on how it looks. And Beth, we have some highlights of the site that we think are really important for people to take a look and really help educate them, which includes guides and checklists. So under the guides and checklists section, Beth, you know, we want to have updated guides and checklists. I know right now we have a guide on Medicare and COVID-19 and how that looks. And so those things are important to us and as far as the education.
One of the things that I think it's important for us as advisors to do is educate our clients. And, you know, I don't want my clients to ever feel as if they have to tell friends or family exactly how they work with us, but I always want them to be in a position to tell us what it's like to work with us and to be able to speak intelligently about some of the recommendations that we make. So general information like Medicare, the CARES Act, the Secure Act, when it came out in January, you know, an educated investor is going to make better decisions for themselves over time, and that's what we strive to do by putting information like this onto the website, so that we are helping clients to make good decisions over time.
Yeah. So also on the website, you can access our Your Wealth Health past shows. So we have that on there, and you know, there's a lot of good topics under that. As well as, you know, we give away some free books if we have a guest that has a book. And so I know we've done that in the past, and that's available. One of the things we do as well is we do workshops, whether that's live workshops. And right now, based on the situation, we're not doing any live workshops. But we have some online workshops that folks can sign up for and watch and get updated on many different financial topics. So that's important as well. And really, our graphics are intentional. You know, we think about somebody in their goal, they're climbing the hill, climbing the mountain, they're going up, and then when they get to the top, they're on their way down. And we want to help them with that journey, and it is a journey. We have a Volatility Resource Center as well. So there's a lot of information on the site that we encourage you to visit, and we'll continue to update that information as times and things change. So we're out of time for this segment of Your Wealth Health. I do thank Beth for joining me today and beaming in from up in Royal Oak, Michigan. And we hope that you'll join us next week for another episode of Your Wealth Health. Thanks so much.